Hi guys, it's Steve from Disruptive Wealth Creation. Today we're looking at whether it's a good idea to invest in an IPO. What is the risk reward? Should you invest on the first day or should you wait? Stay to the end and see what my strategy is. Last year, in 2021, it was a bumper year for IPOs. Over 1,000 companies IPO'd. So what is an IPO? Well, an IPO is an initial public offering which takes place when a private company goes public and becomes available to trade their stock on the stock market for the first time. In a nutshell, it's a way for a company to raise more money by offering shares to the general public. And then once the public are involved and have shares, they have a say in the company. Investors tend to hear about well-known company brands that decide to go public and IPO. Companies like Pinterest, LYFT, Uber, Beyond Meat, and ABNB. These companies create a high-profile event, and investors get sucked into the hype of wanting to make lots of money because they think they're going to get a super deal. So they reach for their wallets. The truth is that although this may be a time for the company to raise lots of money, it may also be a time for many early investors to exit the company. That is why early investors may increase the hype so that they can maximize their returns. This is one reason of many why investors lose money on an IPO. Another main reason tends to be fraud, where companies are under investigation. Recent examples of companies whose shares dropped after they IPO'd include high-profile companies like Facebook, Meta, and Uber. But there are many more less well-known companies like Casper, Omeros, the Blackstone Group, eToys.com, and Cosmo.co. So, if you do not want to be one of those investors that lose money, you might want to consider the following strategy. In my strategy, there are 5 things that I would look at. The first thing is the price. Is it worth it? If we look at Uber was losing money before they IPO'd, and there was a lot of hype. So, was the price worth it? Well, at the time, the answer was no. Secondly, I would look at how long has the company been around and do they have a good track record? If a company's been around for at least 10 or 20 years, you can look back on the company and see how they've been performing, and that will give you an idea of how good the company is. Thirdly, have they got a good track record when it comes to a recession? If they've been around for a while and they've been through a previous recession, then that will give you an indication of whether they're strong enough to succeed as we move into a possible new recession. Fourthly, what are the company's long-term prospects? Have you seen what their long-term vision is? Have you seen what they've achieved so far and what they are looking at doing? Fourthly, remember that there are inside investors who may be wanting to sell their shares in the company as soon as the company IPOs, and that may affect the price. Fifthly, not all IPOs are bad. I mean, let's face it, every company that's listed on the stock market has IPO'd at some point. However, having said that, when a company does go public, everyone can see their numbers and everyone can scrutinize them. It's a lot different, and there are more challenges having a public company than a private company. So let me know in your comments what you think. Have you previously invested in a company that's IPO'd? Which company was it? How did it fare? If you haven't subscribed to this channel, please think about subscribing if you want to see more content. Thank you for watching, and all being well, see you in the next one.